Your host, Jesse Ray. I'll be alongside two legends in the real estate space. You see him here, Josh Metal and Sam Wegert. Now, I'm extra excited because we're going to narrow in on two main strategies that have changed my life and have built generational wealth for a lot of others. These two strategies are my favorite because not only are you able to actually generate cash flow, which is hard to do in today's market, but we're able to generate way more than the traditional single family rental. So instead of a couple $100s, we're looking to generate at least $1,000 per property. And if you're a new investor looking to get started, you can also potentially live for free. So what are these two strategies? They are house hacking and co-living. So I'm going to let these two legends I mentioned earlier dive down deeper and break down all the advantages of this market and how to create cash flow and build generational wealth. First off, leading us off, Mr. Josh Metal. He'll be giving us a background and painting a picture of what the residential real estate market here in the US looks like. Before I get started with that, I want to give a little bit of a background on Josh. He is a mortgage banker, private money lender, entrepreneur, and real estate investor based in Park City, Utah. As a division president at Neo Home Loans and a business owner, he specializes in custom financial solutions for medical professionals, entrepreneurs, and real estate investors. And I didn't know this about you, Josh. You actually played football at the University of Northern Colorado, and you began investing in real estate in 2001 with your mother, Cynthia Hale. And your family office now manages a portfolio consisting of 170 commercial and residential doors, a portfolio valued at over $100 million, generating more than $6.5 million in annual rental revenue. Speaker, author, podcaster, Josh shares his expertise through podcast, books, and seminars. And outside of your work, you enjoy spending time with your family in outdoor adventures. Josh, the floor is yours.
Thank you, my friend. It's great to be here with you both. This is the first webinar I've done with Sam, so I'm so excited to learn from you, my friend. And I thought where we would maybe kick off today is a little bit of a look back at the 2024 housing market and then look into 2025. Now, here's an interesting fact. Over the last 10 years, I have only purchased 8 residential properties. We moved from the first 10 years in real estate investing, we were in residential, then we moved into commercial. But in the last year, we have purchased 8 residential properties. So when I put together a thesis, a presentation like I'm going to show you today, selfishly, it's not for you, it's for me, because I'm trying to figure out where to put my dollars and what's going to appreciate and where do I have the greatest amount of opportunity to grow my wealth. So the presentation I'm going to show you today is the why I have decided after 10 years of not investing in residential real estate to acquire what is now, I believe we're actually acquired our 8th residential unit in the last 12 months. So with that, let me dive in, and I'm going to go numbers heavy because I hate when people say, oh, just buy. It's a great time to buy. Should I buy? It's always a great time to buy. I hate that. I want to give you the information you need so that you have the confidence to enter this market. Whether this is an owner-occupied purchase or if this is an investment property, you want to make sure you're not doing that at 2008, right before the floor is about to drop out. So here we go. Let's jump in with the data. Before we go into 2025, let's look at 2024. U.S. existing home sales are set to close at 4 million in 2024, marking the worst year since 1995. Did you guys know we sold less existing homes in 2024 than we did in 2008? You have to go back to 1995 to see that low of a number of sales. And here's another interesting piece of information. The population today is 28% larger than it was in 1995. So we have 342 million Americans that only bought 4 million homes, larger population, lowest number of sales. Sales are lower than the financial crisis. The lack of demand for existing homes comes as home prices have jumped 50% since 2020. And over that same period of time, mortgage rates have nearly tripled, making affordability even worse. The average rate on a 30-year mortgage is up 100 basis points. That's 1% since September alone to 7.1%, despite the Fed cutting rates by over 100 basis points. So the Fed cut short-term rates, long-term mortgage rates go the opposite direction, up a full percent. And they end off by pointing out the U.S. housing market is frozen. So my question to you is this. if we sold less homes than we have since 1995, if mortgage rates have tripled and the housing market is frozen, how is it that home prices nationally are still going up? That's the biggest question in the real estate market that I don't hear a lot of people talking about. How is it that we didn't see a 20% housing rate, or excuse me, a 20% housing market correction? If we look back at appreciation rates, this data comes from Redfin, and one is MLS data. The other line is CoreLogic's Case-Shiller Home Price Index. They basically shadow each other, but you can see the percentage of appreciation coming out of the Great Recession. We peaked at appreciation over 10% at about 2014. We then moved sideways with about 5% annual appreciation. Then we saw COVID and the super low mortgage rates. And then we saw just an unbelievable spike in appreciation and a leveling off around 5%. How is that possible? How do we still seeing 5% year over year appreciation despite mortgage rates that topped 8% in 2023 and despite the fact that we sold so few homes? Well, I'm going to answer that question in today's data. And spoiler alert, it comes down to supply and demand. So a lot of people have pointed out, a lot of the media have pointed out that we have a growing amount of inventory. This is the number of active listings for sale across the United States going back to 2012. And if you look in 2024, we have this kind of upward growth here where inventory is starting to grow. In fact, year over year, our inventory levels are about 12% higher than they were in the previous year. And that is causing some in the media to say the sky is falling and we're going to see another housing market crash. As they're saying that, I'm rushing back into the residential housing market for the first time in a decade. Because what I know is up 12%, but compared to what? If we look back to the pre-pandemic period, 2012 to 2019, which I just showed you, we've oscillated between 10% and 5% annual appreciation rates. We still have 32% less inventory for sale today than we did pre-pandemic. That tells me that we're likely to see appreciation greater than this previous decade where we still saw 5 to 10% appreciation. It all comes down to supply and demand. Now, I want to get into where are mortgage rates headed and why do I believe residential real estate will do incredibly well over the next 10 years? And why did I buy 8 properties last year when I haven't done so for almost a decade? Here's what I know. Inflation is the predominant predictor of mortgage interest rates. It's not the Federal Reserve, it is inflation. And the predominant driver of inflation is the job market. So let's take a look at the job market because that is the precursor to where inflation is going and that is the precursor to where mortgage rates are going. So the unemployment rate bottomed in 2023 at 3.4% and today it's about 4.1%. So we can see we hit a cyclical bottom in unemployment, meaning the rate of unemployment is rising. We also know that once somebody is unemployed, the duration of their employment is increasing. In fact, it's a 21% increase in the duration of time to find a new job over the last 7 months. That means once I get let go, I'm having a harder time to find a new job. If we have less people in the employment market, that's less dollars in the economy. That means you have lower inflation ahead, and that's going to be a harbinger for lower mortgage rates. How about closing time? These are businesses that have closed. This is Party City that's closed 850 stores. Big Lots closed 580 stores. You get the point. There's lots of businesses that are closing. We also see corporate bankruptcies on the rise. Don't look now, but in 2024, we had more corporate bankruptcies than we did in any time since 2010. So you see store closures, you see bankruptcies, you see the unemployment rate going higher, and you have people having a harder time to find jobs. All of that points to lower inflation ahead. And if you're looking at the JOLTS report, which is widely reported, this is the number of job openings across America. It has sharply dropped over the last 2 years from over 12 million job openings down to over 7.6 million job openings. Now, this is in conflict to the narrative that we hear from the mainstream media about this strong and resilient economy. But is it really all that strong and resilient? You see, we've been getting our job numbers over the last few years from what's called the Bureau of Labor Statistics. That's kind of the headline job number that we get every month. And they might have a little bit of funny books with the election year being last year. And we're about to find out what those real numbers might be. Non-farm payrolls, which is normally what you hear when they talk about a job report, they survey 670 businesses to come up with this indicator of how many jobs the economy is adding each month. And they have said that we've added 2.5 million jobs over the last year. And that's from Q3 2023 to Q3 2024. Interestingly enough, there's another report. This is an initial report that only interviews 670,000 businesses to try to get an indication of the economy and jobs growing or contracting. There's what is called the QCEW. This is the quarterly census of employment and wages. And this survey is where the rubber meets the road because they actually get data from 12 million businesses. The BLS report, 670,000 businesses. The QCEW, 12 million businesses. And their initial report that came in October, their final report will come out in February 19th, so just a couple of weeks from now. They surveyed 95% of the labor market, and they said, we think there's only been 1.24 million jobs created over the previous year. That strong and resilient economy is not that strong and resilient. There may have been 100,000 job per month overstatement in the number of jobs added last year, which is weird because it was an election year. So I can't really figure that out, but you guys are smarter than me. Maybe you could help me figure it out. All right. So where does that put mortgage rates? Okay. We think that we're going to see a slowing labor market. We think we're going to see slowing inflation. That means that we should have a benefit to mortgage rates. Now, we think that mortgage rates will come down because we believe that the 10-year Treasury will go down. And there's a very close relationship, if you will, between the 10-year Treasury rate and mortgage rates, which I'll get into a little bit on the next slide. Right now, we sit about 4.4 on the 10-year Treasury. We think it's going to come down to about 3.6, which is a level it hit in 2023, a level it almost hit in 2024, and a level that it hit almost, well, let's see, twice in 2023 and hit again in 2024. We believe we're going to hit this 3.6 floor with the slowing economy in the year ahead. And we'll also see mortgage rates improve because there's a relationship between mortgage rates and the 10-year Treasury called the spread. They tend to move in lockstep with one another. I'll show you over the last 25 years here that this is the spread between the 30-year fixed mortgage rate and the 10-year Treasury. And you can see it trades sideways here, normally between 1.6 and 2%. There are times when it gets really blown out, like in the Great Recession, mortgage rates were 3% higher than the 10-year Treasury. And we saw the same thing last year. Mortgage rates were 3.1% higher than the 10-year Treasury. Right now, they're 2.5%. We believe those will continue to come down. The spread will narrow and we'll see mortgage rates closer to 2, maybe 2.25% above the 10-year Treasury. So if we have the 10-year Treasury coming down, we have down to 3.6%. We have the spread between the 10-year Treasury and the 30-year fixed narrowing to 2.25%. That means we're estimating we're going to see 30-year fixed mortgages here in 2025 down to 5.85, which is massive relief because today, we're sitting right around 7%. So what happens when real estate payments get cheaper? Well, we bring people off the sidelines. When your payments are lower, you have more people leaving the rental market and entering the buying market. So this bodes well for the appreciation rates in the year ahead. Let me get into, and I'm going to go through this as quick as possible, but I want to make sure I get you all of the information you need to understand the massive wave of demand that's coming for housing. And it all comes down to supply and demand and demographics. First, let's just look at the U.S. housing market really quickly. So we understand how 2025 is very different than 2008, 2010. So currently, there's 136 million households in the United States. 45 million of them rent. 91 million of them own, and collectively, they have $37.3 trillion in homeowner equity. The average homeowner has a net worth or equity in their home of 407,000. Of those owners, that 91 million, 35 million homes are free and clear. That's 20 trillion in equity. 56 million have a mortgage on them. That's another $17 trillion in equity. And the average amount of equity of a mortgaged home is $311,000. That is the big difference between now and 2008, 2010, depending where you were in the country when the Great Recession hit you, is the massive amount of equity. So even if we did have a slight pullback in home values, you wouldn't see people panicking and short selling and going to foreclosure because the average mortgaged home has $311,000 in equity. Okay, where's all this future demand going to come from, Josh? Well, I believe that demographics are destiny. So I want to walk you through the tsunami of buyers that are about to come into the housing market over the next 10 years. So I'll break this slide down really quickly. I've broken these down into different generations. So we have the boomers, which are now age 60 to 78, and there's 71 million. This was the biggest generation our country has ever seen at that time, followed by the Gen Xers, they're age 44 to 59. Big demographic drop off there, only 65 million Gen Xers. Then the millennials, the biggest cohort of all time, age 28 to 43, 73 million in this cohort, followed closely by Gen Z. They're age 12 to 27, and there's 69 million Gen Zers. So huge demographic numbers here, especially compared to Gen X. And these folks are starting to become the age of first-time homebuyers. So let's break that down. There's 73 million total millennials, and their median age is 35, right? Because they're between 43 and 28, so their median age is 35. Their current home ownership rate is 45%. If we look at the younger millennials, let's look at the millennials that are age 30. So they're on kind of the trailing edge of this millennial curve. There's 40 million of these folks, and their home ownership rate is only 33%. You can see as they get older, their percentage of home ownership spikes. So currently, the 30-year-olds are only 33% owners. We can then deduct that as they get older, we will see a lot more homeowners and a lot higher home ownership percentage. And check this out. When millennials reach the age of 40, 55% of them own homes. So over the next 10 years, the home ownership rate should rise from 33% to 55% as they get older, which equates to 8.5 million more homeowners. But that's not all. Gen Z is right behind them, another huge cohort. The median age of the Gen Zer is age 20, and the home ownership rate is only 8% because this is a very young cohort. But over the next 10 years, the home ownership rate, if they follow in the footsteps of the millennials, should increase from 8% to 33%, which means you have 17 million more homeowners. So if we add this up, team, we've got 25 million new homeowners moving into home ownership over the next 10 years. That's about 2.5 million buyers per year. Well, the issue is we're not building that many homes. So where are these people going to go? What's going to happen to the housing market? I'll give you one other graphic just to look at. We know that the average age of a first-time home buyer is age 38. So if we go back 38 years ago from 2025, we arrive in 1987. And what was happening with demographics at this time? Well, it was exploding. Over here, this is your Gen Xers. This is my generation. My generation was impacted by things like Roe versus Wade, when abortion was legalized. My generation was impacted by things like contraceptives becoming mainstream and acceptable. And we had a huge fall off in demographics, which pulled demand out of the housing market. The exact opposite is happening with the millennials. And you can see that these folks born in 1987 had extremely strong demographics, with the US birth rate rising from about, well, its low of 3.6 million. Now this demographics going forward over the next 10 years are extraordinarily strong because we see the US birth rate go up to 4.2 million. So this is the huge wave of buyers that are waiting to come off the sidelines as they get a little older and perhaps as they wait for a little bit lower mortgage rates. I'll give you one other picture of supply and demand, and then I'm going to turn it over to you guys here in about 5 minutes. So this is household formations. What's a household formation? Okay, so currently I'm married and I have 2 kids and we have 1 household. But what's likely to happen is when my son turns 18, my wife is going to kick him out. Now I will have 2 households because that'll create another household. Then 4 years later, my daughter turns 18. She goes away to college. That creates another household. Shortly thereafter, I'm sure my wife will kick me out and then we'll have 4 households. So anytime there's a divorce or a kid moves out, that's called a household formation. And if we go back over the last 4 years, we can see roughly we're creating about 1.9 million household formations every year. Now, when somebody leaves their parents' house, they got to do one of 3 things: buy a house, rent a house, or move in under the bridge, right? Those are the only 3 options that I'm aware of. So if we know that the large percentage of these people are going to buy or rent, we can kind of get a gauge for what is the demand for housing going forward. Well, let's overlay this with the number of new homes coming to market. This is homes that builders are building each year. And you can see going back over that same period of time, this number's vacillated a little bit. This would be 1.5 million over here. But roughly, we have this band over the last 4 years where home builders are building between 1.3 million and 1.6 million new homes per year. So what does that do for supply and demand? Well, we have 1.9 million household formations, and we have 1.3 million housing starts. And these housing starts, by the way, guys, they include residential single-family homes and apartment units. So you've got a gap here of 600,000 people, the new household formations, they got to move somewhere. Like you can, by the way, isn't this a great setup for co-living, you guys? Because the builders just cannot keep up. So where do these people go? All right, teeing you guys up. All right, let me get to the rest of the forecast. I'll turn it back to you, Jesse. So here's what we think is going to happen, team. We think that home price appreciation for 2025 is going to be somewhere between 4 and 4.5%. If we see mortgage rates come down in the first half of the year, I think we'll drive that number north of 5. If we don't see mortgage rates come down to the middle or the second half of the year, we'll still end up in about 4 to 4.5%, which is roughly where we finished 2024. We believe that the unemployment rate is going to rise to 4.5 to 4.6% from 4.1. That's going to slow down inflation, and inflation is the primary driver of mortgage rates. And we think mortgage rates should decline to that 5.75 to 6% range from current 7%. I'm going to show you one more slide, and then I'm going to stop sharing my screen and send it back to you, Jesse. A lot of people I talk to say, Josh, how do you know that 2025 isn't going to be a repeat of 2008? How do you know we're not on the precipice of another great housing crash? And what I like to show them is this graph of appreciation of U.S. residential homes going back to 1942. We have a tremendous amount of data to look back on so that we can kind of erase our recency bias and not just be looking at the period of the Great Recession, which is what so many of us are anchored into. So let me walk you through this. Starting in 1942, we tracked the national appreciation rate of residential homes according to the S&P Case-Shiller and the BLS report. And what you'll see is in 1942, home values went up 3%, 1943, 11%, so on and so forth. And for this decade, we saw 129% appreciation. That was a good decade to be a residential landlord, baby. Now, the decade before was obviously the Great Depression, probably not that great of a decade, but came out of that very strong. How about the 1950s? 36% appreciation over that 10-year period of time. Excuse me, that was the 50s. How about the 60s? 23% appreciation. How about the 70s? 130% appreciation. How about the 80s? 77% appreciation. And team, not one down year. In 1955, there was 0% appreciation, but not one down year of real estate values through the 40s, 50s, 60s, 70s, 80s. That's amazing. 1990s, down 1%. 1991, down 0.1%. But if you hung on for the decade, you still had 30% real estate appreciation. How about the 2000s? 66% appreciation despite the worst housing disruption since the Great Depression, down 5% in 7, down 12% in 2008, down 4% in 2009. But if you were in a home for a decade, you still had 66% appreciation. 2010s started the decade off, 4% depreciation, 4% depreciation in 2011. But if you had the stamina to hold on through that decade, you still saw 45% appreciation. And team, in the first 5 years here of the 2020s, we're already at 51% appreciation. So I would just simply point out, trying to time the market is a fool's errand. Time in the market is the predictor of your ability to grow wealth in real estate. Jesse, that's all I got. Over to you, my friend.
What a mic drop to end it. Time in the market, not timing the market. Oh my goodness, that
Sure.
was good. That was great.
Thank you.
Josh, that was a great deep dive. And I'm excited to kind of have some questions. I know Fernando, he said, how do you get the 3.6% number? I think that was
Oh,
on, yeah, you want to answer
on
that
the
one?
yep, that was on the 10-year treasury. Um, I study a gentleman who is the foremost forecaster for mortgage interest rates, and he teaches us a lot about candlesticks and technical analysis of different charts. Those same charting can be applied to Bitcoin, stocks, bonds, mortgage-backed securities, the 10-year treasury. But generally speaking, there are lines of ceilings of resistance and floors that there are trading floors. And so what I pointed out was 3 times over the last 3 years, we've seen the 10-year treasury hit 3.6%, and that's kind of been the floor. And so with the pullback in jobs, the slowdown I think we're going to see in the economy, I think we'll easily see that 10-year hit that floor of support and perhaps even go lower. But it's based on a technical analysis and where I see the slowdown of the economy and inflation.
Got it. And one of my main takeaways, because people always talk about, hey, is this going to be another 2008? And just seeing that graph and painting that picture that there's so much amount of equity that people have. And that's one of the biggest differences. That was a big takeaway from me. Sam, what about you? Is there anything that you saw that were like, oh man, I never realized that?
Yeah, I mean, as someone who coaches real estate investors, one of the I screenshotted that last slide. We were talking about all the different years of appreciation.
Yeah,
What I think is really interesting about that is I don't know if the technical term, Josh, you might even know, is like that's appreciation on the total value of the home.
Mm-hmm.
So that's not appreciation on the equity that's in the home, right? The if so
Nailed it.
so meaning if I had a home through all of those decades, but I had a mortgage on it, so therefore like the equity that I had is actually appreciated at a much faster rate depending on how much leverage I have in those homes. I think I'm explaining that too complex. Maybe you guys could make that sound simpler for people, but basically like the appreciation's even off the chart on your equity if you use leverage, if you use banks' money, if you use other people's money. So yeah, pretty freaking cool. I'm gonna talk to my investors about like this is another huge reason why we're in residential real estate.
100%.
Well said.
Well, Josh, is there anything else you want to mention before we kind of go into my story and co-living and then Sam, and then maybe we can wrap it up with some Q&A at the end?
Nope. I'm super stoked to learn from you guys. Let's roll.
That
Cool.
was awesome. Thanks, Josh.
Yes, Josh, that was amazing. Well, you mentioned a couple times the people that are on the sideline, and I was that person on the sideline in my mid 20s. I was always nervous, like, how do I get into real estate? It seems like such a, everyone's got to be super successful and have a ton of money before they get in. And so I finally decided to make it happen, and I did pretty much the most basic way to get in, which was through house hacking. And I just want to share my quick story because I think this tees up well to what Sam's going to talk about. So 2021, I bought my first property out here in Phoenix, Arizona. House hack, lived in one of the bedrooms, rented out the rest. And with that, I was actually able to live for free with everyone else who was living in my house, paying the mortgage. Plus, I had an excess in cash flow at the end of the month. So that was my introduction. I think that's probably the easiest way for people to get started. And then fast forward another year, I'm like, let me do this same concept. So I got another house the next year. So everything's going great, right? I have 2 houses within 2 years, jobs going well. But then here comes the twist. And this twist is something that I really want to kind of share with a lot of the people listening. So I just get the second house and I'm getting everything ready for people to start moving in. And literally a month later, I get an email from HR. Now, I come from a sales background. I was number one in my company in sales, but I transferred to a different company. And in that company, I was still in training. So in my head, I'm thinking nothing bad ever happens with HR because I've never experienced that. Very naive. So I hop on the call with HR, say, Jesse, I know you're, doing well in the training, but because the time of the year and economics, whatever, we have to cut half your team.
Mm.
I'm like, awesome. Great. Did not see this coming. And at the time, I was, definitely nervous, but they said, hey, Jesse, guess what? We have another level of our division that you can apply for. I'm like, perfect. Obviously, they're going to beg me to come work with them because it's a lower level sales team. I already got the other job. So I remember just going in. I remember like it was yesterday. I go in and have a meeting with these two managers, and we're sitting down, and they say, hey, Jesse, your schedule's not full. Why aren't you booking meetings? In my head, I'm like, I just got fired. I'm not going to set up meetings for someone else to make all the money. So we're having this back and forth, this dialogue. They're interviewing me. And at the very end, they're just like, you know what? You're in sales. Jesse, sell yourself to us. And I don't know. At that time, I was just, everything was kind of happening at once. And I looked at them. I'm like, actually, I'm not in my head. I'm like, I don't even know if I want to work with this company anymore. And then I'm asked them this question. I said, how much is a salary? And they said, right around six figures. I'm getting goosebumps just thinking about this. They said, right around six figures. And I'm adding up all the rental income from the first house, from the second house. And then when I move out, and I'm like, that's about six figures right there. And I stop and I look at them. I say, hey, appreciate the opportunity, but I'm not going to sell myself because you guys can't afford me.
I
And that was
love
my
it.
last time ever working in corporate. And yeah, I mean, I've been happily unemployed ever since 2022. but I want to
Amazing how
say
that works.
crazy, right? And I want to kind of give people two takeaways there. Number one, I think it's really important to dig your well when like before you're thirsty,
Mm.
right? If I didn't set this up, if I didn't have these two homes, if I didn't do this co-living strategy, I would have been hands tied behind my back, been like, okay, guys, let me sell myself to you, whatever it takes. I want to do the job. But I was in a position of power at that time because I had this rental income. I think I'm very grateful for that opportunity. And so just, be sure to invest in yourself, invest in assets. And then also co-living is just an awesome strategy because if I would have done a regular short-term or not short-term, but a regular long-term rental with the properties that I had, it would have just gave me a couple $100s of cash flow, not the thousands I was able to, give me that leverage during that interview. So I want to have some inspiration out there before we turn it over to Mr. Sam Wegert, aka the co-living king. And I want to give people, a little background about you. You're known as the co-living king, the number one authority in co-living, and you're on a mission to solve the affordable housing crisis while empowering others to achieve financial freedom. And you do this by creating quiet, clean, and safe co-living communities, which I stole that slogan just to let you know, Sam. And you're really transforming lives just by, helping other people get affordable places, but also helping the investors get into real estate and able to, generate cash flow. At 23 years old, you and your wife were able to achieve financial freedom through this strategy. And now you passionately share about co-living, and you're a mentor of mine. So I just want to say I appreciate you, and the floor is yours.
Thanks, brother. Well, I don't think there's any greater sales pitch that needs to be done for co-living other than I had two homes and I retired from a six-figure job. So
Seriously.
I don't know if I can add anything to that, brother. Like that's pretty badass. I always use you as an example. I know we've, done some collaborations before, but that is so. I don't know. When I grew up in real estate, my mentors in real estate, Brandon Turner being one of them, have a huge appreciation for Brandon Turner, love him to death. But it was like, okay, you need $100 in cash flow per unit. Well, the lifestyle my wife likes to live and I like to live, that's hundreds of units, right?
Yeah.
And so I'm trying to shift people's mindsets from you used to need
Mm.
hundreds of units to retire in real estate. And I did a seminar. I'm doing a seminar this week. And yesterday I said, guys, based on what I'm showing you with co-living, put in the chat how many homes you need to get to your first level of financial freedom, which we call ramen noodle financial freedom, where all your basics are taken care of.
Yep.
And there was not a number above 4 in the chat out of 200 people on a Zoom call yesterday. Above 4. Like there might have been, that's not true. There might have been one guy that was that was a baller at 5, and he's like, I need 5 homes to do this. But still it's 5, right? So I think
Yeah.
that's the that's the really, 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 really cool opportunity here that I think is really beautiful. So I'll share a couple of things. I'll rapid fire through this so we can just open it up and chat about this. And Jesse, you've got so much knowledge in this space too, man. I don't want to steal the show as from you as well, just because I think there's a lot here, despite what the big bobble. So co-living real estate is really simple. If you've had a roommate, you've done co-living. It's that simple. It's as simple as saying, you know, I'll get through this here. This is basically how to retire with as few as 5 rental properties are left without this insane time commitment of short-term rentals or needing millions of dollars and all this real estate experience. You don't need that. So co-living is really simple. It's instead of renting out a home to a single family, you rent it to multiple renters who each take a room. As one guy from Berlin called me and said, Sam, you're talking about this like it's brand new. It ain't brand new. We've been living like this way for decades in Germany. And he gave me this phrase that I really liked, and it stuck with me. He said, Sam, in Germany, the room is the new apartment. He's like, millennials don't rent an apartment in Germany. Like, it's too expensive. Not in Germany, in Berlin specifically, right? So they share a common kitchen, common living space, and it helps solve affordable housing because it provides the local workforce with a lower cost option. I made the mistake of talking to a municipality one time, their housing authority, and I said, we're doing affordable housing. She goes, well, how much money do the people make that are in your homes? And I was like, well, they make between $15 and $25 an hour. She's like, that's not affordable housing, that's workforce housing. And she gave me so that there's levels to this pyramid of affordable housing, but it's really, think about it as affordable housing, think about it as solving workforce housing. And you as the investor investing in co-living homes, guys, that means you need less homes because you're getting more cash flow. Jesse being case in point, right? So it means you need less homes to achieve financial freedom, right? So I always love to give this example because people, especially investors, they can't really fully wrap their head around this until I give this example. I bought a house. This house I bought like 2 years ago, and it's just a good example of this strategy and the power of how it can set you financially free. So this house that I bought, it was 3,200 Denson Place, Charlotte, North Carolina. It would have rented for $1,985 a month. That's the single family rent on this property. No, I didn't throw that number in here. That's what the bank appraised it at as what it would rent for monthly, called a rent appraisal. And let's say we throw some in for maintenance. Let's say we put 0 for utilities, because if I'm renting it to a single family, usually that family is going to put utilities in their name. Yep. And then let's throw 10% in for management. So we got 200 for management. And then we get to this number. It's $1,635. That's technically called the net operating income. That's the money I have left over to pay the mortgage, the taxes, and my insurance, and hopefully cash flow. The problem with this particular home, and this is a real home, this is not like a theoretical example I'm giving you guys, this is a real home, and was that I would have lost like $350 a month every month by renting it to a single family, because my mortgage and my insurance and my taxes were higher than that. And if somebody's listening to this call or you're watching a replay of this later, like, how many of you really want to get into real estate and lose money every month? Like, not me, right? So, but I didn't. I rented this to 8 individuals, and we rented it out for and by the way, we rented it in 2 weeks. It was filled for $6,450 a month. Can't help but smile at that number. It's just such a nicer number than the first one. And you might say, well, Sam, okay, like I get you're renting it for more, but surely there's more maintenance. Yeah. Sometimes there can be more maintenance. So we're going to more than double the maintenance budget, right? Well, Sam, you're also paying for utilities, right? Well, yeah, because I want it to be a one fee and everything's included. So I'm going to stick in my budget for utilities. Well, Sam, you've got to be paying someone more for managing that thing. And the answer is, yeah, you're going to pay more for management. But even with increase in maintenance and utilities and management, it left me with $4,950 to now pay my mortgage, pay my taxes, pay my insurance, and cash flow about $2,000 a month on this home. Huge difference, huge strategy difference, right? And of course, now we're providing housing to 8 different people that need it, that might be under the bridge, Josh, if if they don't, if they're not renting a house, buying a house at the end of the bridge. And we're solving kind of these 2 big problems here. We're helping investors and we're helping have affordable housing. So a little bit about my journey into co-living. This was actually a picture of the actual apartment. I walked through that hallway many times in my teens and early 20s. And I bought a 3-bedroom, 3-bath, similar to your story, Jesse. Just kind of bought this place, lived in one room, and house hacked it, meaning I was living in it. And I think it becomes co-living when it becomes an investment, a pure investment. And I lived for free. I made a little bit of money. I didn't think anything of it. And I moved to Charlotte for work. I was building a chain of martial arts schools at this time in my life. That was my main gig. And I had no leases. I had no house rules. I had no parking arrangements, all things you need for a good co-living home, by the way. It's why I'm dedicated a large portion of my life to teaching the systems of co-living. I had none of that. Right. I even had this one guy, he squatted for like 3 months. I couldn't get him out because like I didn't have any agreement with him. It was the weirdest thing. Right. And I was fantasizing about how I could go lock the breaker box and like turn off the breaker to his specific room. I didn't do that, but that was like in my fantasy of how I could get this guy out of my house because I didn't have the systems. I didn't know how this was run. I was just totally winging it. Right. But I had fun. Actually, despite the story about that guy, my other roommates were really fun. We'd do a bunch of cool stuff together, and it was a cool environment. And I had 4 bedrooms, I had 3 baths, and one day I'm walking with my friend, and my friend was a vice president of a local bank, and he goes, "Sam, how much are you renting that house for?" He's like, "I know you're doing it by the room," and I was like, "Well, I'm doing it for like $2,870." And his jaw dropped, and he was like, "That's more than double." Like that house at the time, it's like a decade ago, that house would have rented for $1,300. He's like, "You're doubling the rent?" And he just he's a numbers guy. And I really, like, at that time, I wasn't as big of a numbers guy. He's like, "Wow, that's amazing." And the fact that it impressed him impressed me. I was like, wait, maybe. And that's where it kind of clicked. And I thought, maybe it'll work with 5 bedrooms. And I'm a crazy, like you, Josh, and like you, Jesse. We are limit pushers. I can tell that. We're limit pushers. We want to see if it'll work with bigger numbers. So I'm like, will it work with 5 bedrooms? And we had these things called peanut butter problems with this particular home. Is the actual picture of the home. I've since sold it, but you'd get a call from Johnny, and he'd call you and be like, "Sam, Susie's in the kitchen and she ate my peanut butter last night." And like, now I have no peanut butter. And I remember the first time I got a call like this, I was like, if I ever have to deal with this again, I never want to buy another co-living home in my entire life. So then we started labeling stuff. We started putting systems. We're like, okay, we're going to label cabinets. We're going to label refrigerator space. Heck, we're going to label where they put their damn dish detergent. Not their dish detergent. This shows you, my wife always makes fun of me. The laundry detergent. Because like, I can't have them steal. Like, there's a space and a spot for everything. So we solved it. And then I went crazy and I said, will it work with 6 bedrooms? And that home, by the way, funny story. The reason I was late is because I just sold that home like literally an hour ago, which is really cool because we bought it for 305 and we sold it for 700,000. Side note, super excited about that.
That is really cool.
But in this home, we had, per appreciation that Josh showed earlier, like this works. We all should be buying. And I had parking problems and HOA problems and all this stuff. And the HOA actually sued me over this house because they were like, "You can't do co-living." And I was like, "I can do co-living." That's why we stay away from HOAs. But I say that to say I had to figure out some more systems. I had to figure out some parking and some challenges. But the cash flow in every single one of these homes was worth it. And soon we started filling 7, 8, 9. My student just launched an 11-bedroom home in Concord. It's crazy. And I know that may sound crazy to the people on this call. But when I had 3 homes, I met this guy. And if anybody is into real estate, you know who this is. It's Robert Kiyosaki. And I went up to him at a conference I was at, and I said, "Robert, I have 3, I think at this point I had 4 co-living homes." And I said, "Look, man, I'm nervous because like, I don't see anybody else doing this." This was like 8, 9, 10 years ago. It's way bigger now than it was back then. But like, is this a thing? Like, should I go all in on co-living, this room rental thing? Am I going to get in trouble? Is this illegal? Blah, blah, blah. I didn't know a lot of things back then. And Robert looked at me and he goes, "Sam, co-living is definitely the wave of the future. You should go all in on it." He just gave me that like vote of confidence. And so I went all in. I needed that like little push. And then he leans in over the table that I was talking to him on. And he was like, "Actually, when crap hits the fan," because he's a little doomsday-ish and he still is now, but like, he's like, "I know exactly how I'm going to co-live my home that I live in on a lake." He's like, "I'm going to put a wall here, wall here." He's like, "I'm going to turn it into 6 units. And if I get desperate enough, and I thought if it's good enough for Robert Kiyosaki, it's good enough for me. So Josh already covered a bunch of numbers and talked about the supply and the demand and affordability. So I'm not going to go into this a bunch, but basically like the net of this slide is that point number 3 is the one I want to draw everyone's attention to. We are 7.3, depending on which economist you talk to, or at least 7.3 million affordable and available rental homes for renters with low incomes. That's up 8%. And 8% when we're talking about millions is a lot, guys. Like, we're not talking like, oh, that's hundreds of thousands, if not millions. So beautiful. And then obviously all the debt that kids are coming out of school with, like they don't have the same debt to income ratio that they used to have. And so I always tell people, because people always ask me, "Sam, how does the government view this? Is that legal? Can you actually put that many people in a home?" And I usually draw attention to this thing that the U.S. Department for Housing and Urban Development came out with, where they basically said, we believe in co-living. I'm not going to read the whole thing. It's a 3-page article. If anybody DMs me, I can send the article to them. But it basically says shared housing. They call it shared housing. They call it co-living. For-profit co-living is legit. We believe in it. We believe it can solve affordable housing. And you can now use government vouchers for a room and not just apartment for a house. And the vouchers are actually like in Charlotte, the voucher rate is like $870 a room if you include utilities. And that's higher than I would normally rent it for. So the government is overpaying you if you want to accept vouchers. Now you got to deal with the red tape of vouchers. So you may not want to do that, but that is what HUD has come out and just given it a huge thumbs up, a huge endorsement. That's page 3 of that. So anybody who makes $15 to $25 an hour that cannot afford easily a studio apartment in that city, a baggage handler, Frank, he makes $20 an hour. He works for the Houston airport, right? Sally makes $15 an hour plus commissions working for a sales call center. John, smash repair worker, he makes $22.50 an hour plus some little commissions if his center does well, but it's very small, right? These are all people that are living in co-living homes. And if you do it right, you're solving loneliness at the same time. You're bringing people together. And Jesse, I know you're freaking like the OG at this, right? Because you bring people together, and Jesse's got this whole concept where it's only entrepreneurs and you have to cold plunge at 4:30 a.m. every morning, and you have to be buff and big like Jesse to live there. It's like but he's building this really cool, tight-knit community in each one of his co-living homes that is just awesome. It's his niche. It's for entrepreneurs, right? It's called the Growth House for that reason. It's really, really, really beautiful in how he's solving loneliness and building community in his homes. We give our students, I should call them our students. They're not our students. We give our members that live in these homes a Thrive journal that they get money if they fill out and learn about meditation and all of that. So what I want to do really fast is I want to leave everybody just with something tactical. This is what the perfect co-living home looks like. I'm going to give you like 7 criteria that we look for. If you were to go out today and you're like, I get it, Sam. I want houses that cash flow $2,000 a month. I want to be like Jesse and retire a 6-figure job off 2 co-living homes. Like, this is what the perfect co-living house looks like. Now, the example I gave you guys at the beginning, this is the actual house. This is 3,200 Denson Place, the one I gave you the numbers, and it turned into an 8-room home. So as you see, you walked into the foyer, this living room became a bedroom, this sunroom became a bedroom. So there was 1, 2, 3, 4, 5 on the top floor. And then downstairs, the family room became a bedroom. This was already a bedroom, and the rec room became a bedroom. So it was an 8-bedroom home. That's how I was able to get $6,450 in revenue off of that, right? There's some pictures of the inside. We already went over some of the numbers on that. This is another one that we just recently, last 2 years, bought in Fairview, North Carolina. This is on a septic system. It's way out in the middle of nowhere, but it's near Asheville, which Asheville has a huge affordable housing need. Just trying to give you guys a vibe for what it looks like. They told us it would rent for $2,250. We rented it for $5,250, more than doubled the rent. This is one of my favorite homes right here. We did a full rehab on this home. It looks beautiful. My wife staged it and designed it. They said, hey, Sam, if you rent this house out, you will rent it for $1,985 a month to a single family. We rented it for $6,450 a month. And this is the floor plan of that house. This is how we got 9 rooms out of it. We got a room, a room, a room. So whenever you are looking for a good co-living home, you're looking for something that's a little boxy, right? So real fast, I'm gonna wrap it through this. You're looking for ample parking. A good co-living home has the ability to park at least 2/3 the number of people that you have living in the home. You might say, well, Sam, why 2/3? I don't know. We have hundreds and hundreds of rooms. Just trust me, that's the formula. If you have 9 people in a home, you need 6 parking spots. Someone's at grandma's, someone's out, you have 1 vacancy, someone's working second shift, someone's working first shift. You just don't need 100% of the parking spots. So you're looking for on-street parking, add a little parking, whatever you got to do. No HOA, unless you love lawsuits. Anybody here love lawsuits? Then no HOAs. Split level homes are good. They flow really well. So we always are looking for split level homes. You're looking for anything that's 2,000 square feet or larger, which means it's going to be 6 bedrooms or larger. You can always get 6 bedrooms out of 2,000 square feet. I know that from looking at thousands and thousands of homes, right? So that formula is 2,000 square feet equals 6 rooms. And then every 250 square feet that home is bigger usually means I can get another room in that home. So if you bring me a 2,500 square foot home, that's going to be 8 rooms. Bring me a 3,000 square foot home, that's going to be 10 rooms. So it starts at 6, and then 2,250 is 7, 2,500 is 8, 20. That's just almost always 99% of the time that formula works in houses we're looking at around the country. We're looking for funky layouts, weird layouts, homes that are more boxy, I call them. We don't like doing massive rehabs, so we always say minor rehab work because I want to fill this home and I want it to cash flow and I want to move on to the next one, right? not too old. We're looking for something 1970s or newer. Plumbing, electrical got a bunch of updates around the United States around that time, so it's just better. And the more bathrooms, the better. We always keep at least a 3-to-1 bedroom to bathroom ratio. And I get if you're listening to this and your mind is like, how do people share bathrooms like that? You just kind of have to trust me that it works. And I don't have time to dive into all the nuances, but it works. And it's being proved times thousands and thousands of rooms around the United States. And then you want to make the common spaces amazing. So what you really want from co-living guys is you want them to walk in and go, holy cow, I can buy this. I can live in a room in this house and it feels like an Airbnb. Now we don't furnish the bedrooms because the room is the new apartment. So I want them moving their stuff in. I want them signing a 12-month lease, right? I don't agree with this concept of week by week rentals and co-living homes. That's not the vibe. That's not what I'm promoting. It's not what I'm teaching. But you want that common space, which is the only part that we do furnish for everybody, to be like popping and amazing and place for them to work and co-work. And if you walk in one of Jesse's homes, it's like you think you're walking into a 5-star co-living space. It's absolutely amazing. You got lighted signs and neon signs and strip poles and things like that, right, Jesse? Don't you have that? No? Okay. I might have made the strip pole. So I just discovered, guys, to kind of put a bow on this, and Jesse, I'll turn it back over to you, brother. I'd love for you to put a bow on it if you want to add anything to what I've shared, but just that co-living for me is the best way to solve affordable housing. In my opinion, it is the best way to create financial freedom without needing millions and millions in capital and having to go buy huge multifamily units where you're competing against hedge funds and insurance companies and everybody and their brother that wants to buy a multifamily unit. You don't need any real estate experience because it's not like you're managing at massive scale to become financially free. You can do it 3 homes, 2 homes in Jesse's case, right? So I've got some cool examples here. Just for time's sake, I'm not going to run through them, but just some people who have been through this model, been through our program, and have come out with thousands of dollars in cash flow and have been able to either quit their job or move part-time or done what Jesse's done and just do real estate and coaching full-time now, which is really cool. So I'll end with this. If anybody's listening to this and you're saying, wow, Sam, sounds cool, but there's no way that'll work. Like, I get it. I don't get it. I'd invite you to think about what you thought when the first time you heard Uber. When you first time you ever heard about Uber, it was like, wait, an app is going to tell me to go pick up a random stranger. They're going to jump in the back seat of my car. They're going to take me some other random place, not murder, kill me, or hijack the car. And like, that's the new taxi? Like, yeah, that sounds sus and dangerous as hell. Or Airbnb, it was like, wait, you're going to let a bunch of 20-some-year-olds rent your second home on the lake and they're not going to destroy it and that's going to be a multi-billion-dollar company? Yeah, right. But now we just accept it, right? And co-living is in that same place where it's like, wait, 8 people sharing a home, 9 people sharing a home? No way that'll work. But it's people are saying that because this is new, this is up and coming. But it is truly solving affordable housing. So you got to kind of just open your mind to the concepts. And Jesse and I both lived in co-living homes for years and years and years. For me, almost a decade and a half, I lived in co-living homes. When my wife met me, I had 6 roommates. She was like, "Hey, this isn't gonna work for us." But I say all that to say, it does work if you start to lean in and you study it and you move forward with it. So, Jesse, I'll kind of end with that. I could go into some other stuff, but just for time's sake, I want to move it on.
Man, so good, Sam. So good. And I think another thing is this, like, some people have a perception of landlord, slumlord, but at the end of the day, co-living is so amazing because you as an investor, as a landlord, get the feeling of being like thanked and like people are grateful for you to provide these type of environments for them. You have a nice house you're able to live in. You have a great community of like friends. I mean, there really is a loneliness, pandemic going on in the world where people craving in-person interaction. And so besides the fact that we're able to make amazing, money through this strategy, it's the fulfillment from the people that are renting from us that honestly is almost just as, I almost like it just as much.
Jesse, will you
get a ton of loans with Josh's company and go buy as many freaking co-living homes as you can? That's the message of today. Get loans, leverage, and buy residential real estate.
I was really bummed when you said people only needed to buy 4 homes, Sam. I was like, dang it, I liked it when they needed to buy 40. That was way better. No, Jesse, will you tell me a little bit about Growth House? Because, we work with a lot of medical professionals. We work with a lot of entrepreneurs. We work with a lot of real estate investors. And what I know about those people is they like to hang out with other doctors. They like to hang out with other entrepreneurs. They like to hang out with other real estate investors. So give me the Growth House model that you've put over what Sam teaches.
Absolutely. Yeah, it was really more just niching down into a specific industry or type of person that wanted to, like you said, live with other people that were like that. So, for my example, I moved to Arizona, didn't know a single person. And what did I want to do? I want to get out of the corporate rat race and be an entrepreneur and a real estate investor. So, guess what? I literally went on Facebook and just said, "Hey, I'm creating this entrepreneur house because I want to live with other entrepreneurs." And that's exactly how everything really started, was just that simply and that organic. So yeah, it's just like there's a lot of different people in the market where they're musicians or they're travel nurses. And because of some
Yes.
people's schedules, they all kind of, operate on the same hours of the day and they like living with each other. There's now even houses for flight attendants or pilots. And so yeah, it's just kind of adding another layer on top of what Sam teaches with co-living, where it's niching down and basically catering to a certain type of person that has a certain type of lifestyle.
I think if you said to me, Josh, would you feel comfortable living with nine strangers? I may go, I don't know. I'm not sure I'm comfortable with it. Now, if you said, hey, would you feel comfortable living with nine entrepreneurs? It would not take me 1 second for the word yes to come out of my mouth. If I'm going through medical school or I'm in residency and I said, hey, would you feel comfortable going through living with nine other residents? In 1 second, they would say yes. So I think that
Mhm.
familiarity, it's like, oh, I'm going to move into this house and I already have a built-in tribe. I'm in, right? So I think what you've layered on top of that is just absolutely brilliant.
I appreciate that.
Commonality for sure. Yeah.
So, guys, we've got 3 minutes left. I would like to have time for perhaps closing thoughts, and maybe I'll just kick us off. I had three kind of takeaways that I wanted to give. Number one, Sam should go first on the next webinar we do because he's incredible. Thank you, Sam. That was absolutely awesome. Love
You're
your
incredible.
energy.
You're
Your
incredible, man.
con.
Love it.
Thank you, buddy. Your content was incredible. I mean, the numbers for me was so helpful. Like, here's what it rents if you rent it to one person. Here's what it rents if you rent it to six people. Like, that was just so insightful for me. Thank you very much. The other thing that I just wanted to share with folks really quickly in closing thought was I gave a bunch of macro data on the real estate and housing market. And that's only half the picture because the macro picture, I can be right, 100% right in the macro picture. And if you buy in the wrong neighborhood, you're still going to lose money. So
Right.
you need
Right.
to understand the macro market and the micro market. So one of the things that we've developed, we pay a lot of money to subscribe to this professional grade analytics tool that enables us to dial down and get neighborhood level data. So I can go in and I can say, hey, the median home in 84127 is selling for 580,000. There's only 7,600 homes being built there this year. And in that area, there are 89,000 renters who have sufficient income to buy. And that's just one of the data points here. It gets into demographics. Well, the biggest cohort of demographics are 27 to 35, which means there's a lot of new home buyers coming into the market. So if you want something like this that I can help chart for you your future appreciation in this neighborhood, it can even be dialed down into a different price if you were buying a 380,000. Oops, let's not do that. If you're buying a $380,000 house, then these numbers may change based on your area. So if you want micro market data specific to the zip code or area you want to buy in, I will create this for you for free. You can
Wow.
email me at josh@joshmetal.com, or you can drop your email in the chat. I'm more than happy to prepare that for you. Let's send it over to, should we send it over to Sam next? And Jesse, you can close us out.
Let's do it.
Cool.
Hey guys, listening to you, Josh, about about just kind of the forecast, I think it's kind of what Jesse said earlier of like, so often, even in my generation, I'm a millennial, so I guess we like to try to get rich quick a lot of times by timing things. Well, I'll buy this stock now and I'll sell this. I'll do the GameStop kind of play, right? And I think that sometimes I feel like when I talk to my generation, I have to like talk, and Gen Zers for sure, which is like my siblings' generation. It's like, hey guys, like this is a long-term game to not just become rich, but to become wealthy. And rich
Mm.
in my mind is like you can get a lot of cash, but are you gonna be wealthy over the long term, right? And have equity in your homes and all these things. So I love this strategy of like, I'm going to try to buy a home a year for the next 10 years. And I think just playing that out and knowing that, like you shared with us, appreciation is going to take over. Maybe there's a down year or an up year, but it's like over time, this is headed in that direction. And we're not trying to time things. I just, and I know that. And I think a lot of people who are listening to this probably know that. But it's just great to hear that as a consistent reminder, even in my strategy, as my wife and I are going and building assets and building our wealth. It's like, no, just stay the course, stay the game. Because sometimes I get a little greedy and I'm like, well, maybe I'll pour all my money to this stock because I really think it could go great. Like uranium's going to be hot, right? Right? Like I'm going to buy uranium mining stocks. I really want to. My point in saying that is like, I just think we all have kind of that temptation. But seriously, if you guys have some tips on uranium mining stocks, I'm being playful. That's my takeaway. Stay the long term. Appreciate like I want to wake up and pay 50-year-old Sam, and 50-year-old Sam wakes up and goes, "Oh, I'm so glad I bought real estate. And I'm so glad I paid down those loans. And I'm so glad I got fixed rate debt from Josh's company." And like that's nice.
And Sam, the 50-year-old Sam's rent checks are a lot bigger than current Sam's rent checks,
So
meaning
true.
your mortgage payment's the same. Your rents go up every single year. And the first apartment building we bought was in 2001, 850 square foot apartment, downtown Salt Lake, looks over the Great Salt Lake, beautiful sunsets, like beautiful building. They rented for $375 a month. Now we rent those same buildings, those same units for $16.95 a month.
Holy
And we
cow.
charge for parking, and we charge for pets, and we charge for storage. So some of those are almost $2,000 a month. That's only 20 years. And guess what? My mortgage payment's exactly the same. Actually, it's less because I've refinanced it down 4 times over that period of time. So when you start thinking in terms of decades instead of days and weeks, that's where you shift from being quote unquote rich to wealthy.
Beautiful. Well said, man. Great example too. That's beautiful.
Thank you, brother.
I got nothing to add after both of you guys, man. That was too good. So I'm just honored to be on this webinar with you two. And Sam, if people want to find out more about co-living, you have an amazing 5-day challenge. I want you to shout it out because you personally helped me make another $24,000 back in 2023 by me joining that 5-day challenge, even as someone that already is quote unquote in the game and a co-living, person already.
Yeah, man, you just got to go to scaleyourrealestate.com, www.scaleyourrealestate.com. Get on the waiting list for the next event that I'm doing where we will deep dive into how to find these co-living homes, how to run them, how to get them to cash flow. I'm in the middle of one this week, so the next one will be probably in a month or so, but get on the waiting list. I dropped it in the panelist notes as well, www.scaleyourrealestate.com. Thank you, Jesse.
Amazing. And you can find me. I'm mostly on Facebook or Instagram at the Jesse Ray. And we have a podcast, and both of you guys have been on the podcast. So if you ever want to listen to some amazing real estate and investing podcasts, Growth House by Jesse Ray.
Appreciate you guys being here. This has been a ton of fun. I dropped my email, josh@joshmetal.com. If anybody wants a neighborhood report card, wants any information on how to move from thinking about buying a home to actually getting prepared and inspired to buy a home, reach out to me. I'd love to help y'all. But guys, thanks so much. You've added a tremendous amount of value to our listeners today, and it's just a blessing for me to be with you both.
Thanks, Josh. Same. I feel the same way. Thanks, Jesse. Appreciate you guys.
Thanks, guys. Have a great rest of your day. Appreciate y'all being here.
God bless.
Take care.
Bye-bye.
God bless.